globally, interest rates are forecasted to come down in 2024, so that's very positive for emerging market assets. On top of that, we are seeing that certainly in most emerging economies, the economic growth is proving to be resilient this year, and it's likely to be sustainable going forward in the next few years. And thirdly, the valuations of these emerging market equities are very, very cheap, and in fact in the multi-year lows. So these three factors added together makes me very positive, and in fact it may be an inflection year for performance of emerging markets equities. I think the market is expecting, and in fact it is likely, that the US economy or developed markets will slow a bit compared to 2023. However, when we look at the growth rates of the emerging economies, they look strong, they look resilient. And I think the reason is because a lot of the growth in these economies are driven by endogenous factors. And this year they most likely will see some degree of interest rate cuts, which helps their growth. So we think the growth is going to be good. The one thing that's sticking out, of course, is China. I mean, it's very topical. I guess there's a lot of negativity, and in fact, the economy is going through significant structural adjustments. But the good news is, I guess, a lot of the adjustments on the property side has happened already in the last 2 or 2.5 years. And with a lot of the relaxations from the government this year or second half last year, we expect to see some degree of stabilization on the growth front. And in fact, domestically, they're still targeting, around the 5% GDP growth in 2024. And we expect them to get close to that, and that's quite positive, I think. Anecdotally and empirically, the strong US dollar tends to be bad for emerging market assets, and that's been the case in the last 2 years. With the US dollar having gone up quite strongly, that's been a headwind for emerging market equities. Now, with the expectation of a weakening of the dollar, that should help it. And I think the reasons are multifold. I mean, just to explain it briefly, it's a strong US dollar represents a tightening of financial conditions for emerging countries, which slows their growth, slows the risk-taking appetite, and reduces, I guess, fund flow into these economies or these asset classes. Well, I think it's a welcome relief that the two leading countries are talking to each other. Look, I mean, we think it's a thawing of relations. It's not going back to the good old days, but certainly it reduces a lot of the tail risks in global affairs. So we view it very positively on that front. There's a lot of talk of diversification of the supply chain incrementally away from China. It is happening on the margin, also partly because of geopolitics, partly because of the cost of labor in China. So that's been happening for probably a decade now, this reconfiguration. Now, there are beneficiaries of this move, this change. And I would highlight countries like Vietnam, Indonesia, and India. They're actually benefiting through just factories popping up in those countries. And more jobs are created, manufacturing stuff to be sold to, I guess, developed economies. So we're seeing foreign direct investments, going into these countries, continues to grow, and new jobs created, consumption picking up, and exports improving in these economies. Within emerging markets, these few countries, benefit from the reconfiguration of the supply chain. Emerging market equities are basically at multi-year lows. I mean, if we look at the index itself, it's where it was about 10 or 11 years ago. And this is in spite of the fact that these economies have typically been growing at around mid-single digits in GDP terms. So the result is a big derating of this asset over the last decade. Really, I mean, the reason for this, I think, is just two reasons. One is that over the last decade, I mean, the engine of growth in China seems to have slowed a bit, so that impacted the valuations of these emerging countries. And the second is just that the place to be has been developed markets, and then so people have taken the eyes off emerging economy equities. But with the rate cut and the resilient growth and cheap valuations, the likelihood of improvement is high. The Chinese economy is undergoing a big restructuring. I mean, previously it was for the property market, but the property construction growth has been a big driver for its economic growth. And given the maturity of that sector, an adjustment, was always bound to happen. The question was always when. And it's so what we're seeing now is an adjustment taking place in real time, and that's been taking place over the last 2.5 years. So that's kind of a good news because, a lot of the adjustments has been had, growth has slowed, economic growth has slowed, property sales volume for new properties is down about 40 to 50% from the top. So incrementally, a further deceleration resulting from this adjustment is probably not going to be as big compared to the last 1 or 2 years. However, this big adjustment, is leading to, sentiment getting very negative domestically and also in the investment markets. So we think that sentiment is probably too negative, given that growth is still going to be around, probably close to 4 to 5% if one's conservative. And then within that economy, we can see, and we spend a lot of time looking for these resilient companies with long-term growth, strong quality management, strong economic moat that are available basically at very, very low valuation. So from that perspective, we are positive. Given, it's almost like a perfect storm. There's various factors causing what we can see now to be quite anomalously low valuations in equities, particularly those stocks listed in Hong Kong. We all know this. There's geopolitical pressure, there's restructuring of economy, there's on the margin, the supply chain move, which is impacting a little bit, but not hugely. So the perfect storm is leading to the valuations of some of these strong companies being valued at very, very, very low valuations. And because we've been investing for a long time, the history doesn't repeat, but it rhymes. There's been many instances where asset classes or certain sectors are seen as uninvestable, very difficult, but then they're very cheap. But actually, if you think about it logically, in 5 years' time, can these companies be bigger? Can these sectors still survive and do okay? Not even assuming it does really well. And the valuation we're paying is very, very low at the moment. There's been, other examples that lead us to believe that perhaps the similar opportunities are rising, in some of these equities in China. So what we are seeing in a few of these emerging countries, Vietnam is one of them that we like, is that it's basically doing the same thing as China did about 20 years ago. So what they're seeing is, foreign direct investment going in, factories popping up, making stuff to be exported to developed countries and to China as well to some extent. So FDI, fixed direct investment, infrastructure has improved by basically investing in roads and rail and electricity and ports and the like. There's sort of reforms which has come through, which has taken place in the last few decades. And lastly, the result is, consumers are doing well, investments doing well, and exports doing well. And of course, as we mentioned before, they benefit from the supply chain move as well. So we think it's a very interesting opportunity. The stock market in Vietnam itself has not done that well, partly because, we talked about before, partly because of the strong US dollar, partly because of the US rate being high, which does impact these emerging countries. However, that seems to be changing. And given the starting valuation and the opportunity set available, we think it's one of the best opportunities one can get their hands on. Indonesia, actually the story between Indonesia and Vietnam are very similar. Indonesia is a bigger country, right? Vietnam has 100 million population roughly. Indonesia has a few times that. Income level is similar, slightly lower for Indonesia, but it is also seeing this fixed asset investment going in, this foreign investment going in, factories popping up, making shirts, shoes, and some electronics, and consumers doing better, and what else? Exports is growing as well. But on top of that story, Indonesia has this nickel story. So as we know, nickel is a key component to make batteries for storage, for electric vehicles. And Indonesia has basically the world's biggest endowment of nickel. And then the good thing about the nickel is that it's actually on the surface of the earth, so they can mine it very easily. They can produce it at a very low price, and we believe that Indonesia is fast becoming the battery center, manufacturing center of the world because of the nickel endowment. It will take a decade to play through, but this seems to be happening. So there's an added strand of reasons why we like Indonesia. We like these emerging countries which has gone through years of reform and is bearing the fruit of that adjustment. So Brazil is one of them. It's made a lot of reforms and fiscally as well, fiscal reforms. So they're much more fiscally responsible now compared to before. What we're seeing there now is that it's ready to reap the benefits. More cyclically, interest rate has gone up in Brazil from about close to 2% to close to 14% as inflation came through post the COVID stimulus. Since then, inflation has traveled all the way back down to very, very manageable levels, and interest rates have started to be cut since second half last year from the 14%. And as you can appreciate, the equity market has suffered a lot because of this interest rate rise. Now they're actually rebounding, starting to rebound quite strongly. So we like the long-term story of some of these strong businesses in Brazil, and cyclically, the interest rate cuts will benefit valuations a lot, and the valuation of these stocks are still very, very attractive. I mean, we are seeing some of these companies growing at 30% a year, and they would still be on a 10 PE multiple, some of them. So we want to look for the quality ones amongst them, ones with economic moat and good valuation, cheap valuation. What we look for are companies which have strong long-term secular runway of growth. And then the next step is to look for these companies with strong economic moat, strong management, and therefore pricing power. And so that therefore they can take advantage of the underlying secular trend that they're on. And the last point is just the valuation. We like to look for valuations which are cheap, and if they're anomalously cheap, it gets us quite excited. So these are the three things, growth, quality of the company, and valuations that we are, from a bottom-up perspective, that's what we look for, and the portfolio is basically full of stocks like this. On top of that, there is a top-down layer of risk management, and there basically, we track various macro indices and numbers. Basically, we track more than 1 million data points, a few times a month, to try to understand what's going on in the world. And really, the reason for that is to try to pick out times that there may be disruptive forces in the markets. We try to hedge against that, or sometimes the top-down process would throw out interesting upside opportunities, and then we will spend more time looking at those markets when it comes out. Thanks very much for listening. If you would like to know more, please visit our website. Thank you.